let's talk about what's going on right now, the market today. What's your take on the market right now?
I absolutely love the market right now. It brings a lot of joy. So there's like a million statements allegedly Warren Buffett said, most of which he never said. I like the books by Warren about how to trade stocks. Detail, he never traded stocks in his entire career. He buys controlling interest in companies. The one that he said, and I think he actually said it, is when people are greedy, be fearful. Right. And when people are fearful, be greedy. And you and I mean, and it's unfortunate because we know friends that are going to be caught in this. When everything was going crazy in 20 and 21 and early 22, they're just doubling down, leveraging. It'll never go down. What could go wrong? Where the people who've been around, I mean, this is my fifth downturn I've been involved with in my career. You know, we're scaling back and out, and because we only buy for return, and we're looking at how do we maximize the returns? And the biggest way to maximize returns is not to lose money. So now when the market starts to go down, we're very excited. And then, you know, there's so many things out there. I mean, geez, with the social media, it's just crazy out there, as you know. You know, be like, oh, well, the next big crash is coming. It's like, okay, hold on. 2008, could it happen? Absolutely. Is it likely? Oh, heck no. And people are like, why? Okay, well, the first thing is they're all claiming their charts show it's going to be a crash. It's like, let's go to the big chart. So the big chart in the United States goes back to 1765. There's actually global charts that go back 6,000 years. But the reality in the United States, we've had 4 major crashes. They occur every 60 to 90 years. Starting in 1765, well, we crashed in 1790, not too hard to figure out why. We went bankrupt fighting a Revolutionary War. Right. You know, and then we had another crash in 1872, again, following the Civil War. The next one was in 1932. So again, we're consistently 60, 70, 80 years apart. And then there was 2008. So if we're going to be charts, the charts show that there is no big crash coming. They're not back-to-back events.
And I have a theory about why that is always 70, 80 years.
What's that?
Simply that it's the age span of the humans.
Yeah.
They just simply forget. Like the people who lived through it forgot about, now are no longer around to raise the warnings. They're out of the workforce. The new generation is saying, what could go wrong? They don't know. They don't know anymore. And boom, they make the same mistakes again.
All over again. And then, you know, we look at then the other dynamics. I mean, obviously, the last one, the Wall Street is always involved. Wall Street is the main one who buys the secured loans. So the government insured, government guaranteed loans, all those alphabet soup loans, Wall Street buys them. Right. Wall Street still buys them. In 2008, just prior to that, Wall Street got greedy, which is not what they normally do, and because they forget too, Jack. Wall Street got greedy because they're just bookies. If you're bookies, you never lose as long as you had your bets. Well, they went in, and Wall Street got greedy, but what they bet on is they bet on the debt, which was bad debt that they were creating. So when the music stopped, they were dead. This time it's completely different. Wall Street didn't back the bad debt. Wall Street bought the asset. Wall Street is now a large owner of it. So the first thing that does, that softens any bottom. Because you have a huge amount of properties that are free and clear or low leverage by Wall Street that they're not selling. Yeah, there's the Open Door and the Zillows, et cetera, and kind of for people watching right now, what if Zillow was never about real estate, even kind of at all? What if it was entirely a stock play? Because the stock went up $20 billion and they lost $780 million. I'd take that trade any day. Because I would put to you, being from Wall Street, Zillow really didn't care if they made money or lost money flipping. What it did to the stock, and coincidentally, large amounts of options
for the leadership
were available to them to be sold.
So you're basically saying, Zillow, by going into the real estate space and buying large amounts of houses, their stock, while during the boom, of course, their stock went
through the
roof. Which allowed their CEOs and their leadership team to look really good and getting lots of stock options. And hey, losing $700 million is not a bad
chump change to them. So I hear people all the time, you talk to students like, well, blah, 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 blah. I don't understand. It's like, okay, hold on to the last sentence. That's the only part that was true. You don't understand what Wall Street's doing because they're not playing our games. They play different games. I'm from there. Right. So right now the markets are propped automatically because of the fact that they're that. And then, the investor community, in 2005, it would have been normal. And we met tons of these people. They owned 5 houses in Las Vegas. They put a total of $10,000 down for all 5. The rents are $1,200 a month. $1,400 a month would be the debt service, and 2 of them are vacant. So they're bleeding money, just bleeding money every month, and they've got no skin in the game. You take the exact same thing today, that guy or gal with the 5 houses in Vegas, they put $400,000 hard cash in. Yeah. They're renting them for $2,000 a month, and their PITI is $1,200. You're not walking away from that when it falls 50 or 100 grand. So the whole investor walkaway is gone. And then the next thing is the homeowners. Most of them, look, no one's happy the value of their home went down, but most of them are sitting on equity. But more importantly, they're sitting on a 2.5 to 3.5, 4% loan. They can't rent their house for their payment. So they're just not moving. So there are no dynamics that say we have an 8 coming. What we have right now, I think, is we're in the midst, and the market isn't shifting, people. It already shifted. Because the psychology shifts, and then 3 to 6 months later, the numbers start to shift. It already shifted. That's one of the problems with reporting services. They're great, but when you're giving the numbers, you're giving me the numbers, but you're not giving me what's happening in the street. Right. The psychology motion has shifted. And so normally we'd be looking at most markets, a 10 to 20% downturn. And look, I know the news reports the national numbers like it's what's happening where you live. Some areas are more, some are less. And with social media and the massive infusion of negativity from the main media, I could see it being 20 to 30 in some areas based on emotions, not numbers.
In like Arizona, it's already there.
Yeah, right now in Arizona, we're falling 1/4 to 0.5% per week on residential. And then, the other thing is, keep in mind, if you've learned how to invest properly, you've never focused on the macro, you focused on the micro. And what I mean by that, Jack, is look, we're buying a specific house on a specific street in a specific neighborhood that we know well, and we're buying the one that was undervalued. And we're already seeing several people that, in March, the house was $350. Today it's $310-ish. Most people won't sell it for way less than that, but we're already finding the ones, even on MLS, that'll take $230, $225, $235. And then we come in, we work with capital investors and our own money. So then we come in, we buy it cash, or we buy it with a 20 or 25% down payment in a long-term fixed rate loan. And if you've got good credit, loans are available. And if you don't have good credit yourself, you use someone else's.
But before we go into that, let's roll back for just a second and unpack a couple of things we just talked about. So first of all, I 100% agree with the entire assessment. For example, we just like earlier this year and last year, we refinanced several of our properties and even our own house and a vacation home and some commercial stuff and so on. And ask anyone out there that ever refinanced anything in the last couple of years, if they were giving a liar loan, if they were being given a loan that no documentation loan or anything like that, or no money loan. Yes, there's the FHA and those kind of loans, and they're legit, and for veterans and all this kind of stuff, or the VA loans and so on. But the normal person that is not a veteran, and you have to put money down. They scrutinize your credit, they scrutinize your income, they scrutinize everything like crazy, and which is a good thing.
It's a good thing.
It's a good thing because that's what's not happened in 2005, 6, 7, and it's happening now, which means that everyone that bought right now has been qualified. Now, some of them might lose their job right now. Some of them might have to move right now. Some of them will be in distress, but it's in no proportion to anything that happened in 2008.
Oh, you're absolutely right.
It's more like a normal, that happens in every normal recession, that some people get in distress and then they have to sell their property. That's where investors often come in and actually are of help. Right? We're not taking deals away from people. We're helping them out of a difficult situation and saving them from a foreclosure. Yeah, because I don't even do that, but I do land flipping. But
we've got a nice opportunity coming up in both the land and the real estate, the residential, some in commercial, but more in the residential and the land. Where there's a small percentage that are in trouble. Now I know some of the podcast guys, they act like there's a tsunami wave of foreclosures.
Well, a lot of that is also driven from just who screams the loudest is being heard in this world that we live in right now.
Yeah, absolutely. And they just disregard that, the numbers that were released in the beginning of November for October showed 2.7% of residential real estate loans were in distress, which is the lowest number in 40 years.
Right.
So the screaming doesn't match the truth.
No, but the screaming gets you eyeballs, and the eyeballs gets you whatever sponsors and dopamine because you get to see, oh, my reel has been seen 5 million times or something.
Right,
like
where
that.
my dopamine's on the return on my portfolio.
That's right.
Not in my eyes on my podcast.
Right.
Which is, they're both good. It's just for people, it's like, I think it's okay if you and I talk about the truth, which is why I love the conversations you and I have had over the years are great.
Yeah.
I mean, we sit down for lunch and we're both at some point going, oh, we're like an hour past what we were supposed to be.
Right.
People are buzzing. It's like, where are you? You're supposed to be somewhere.
Exactly
It's like, I'm talking with my buddy Jack. Leave me alone.
Right, exactly. So yeah, I love those conversations too. So as a result of that small percentage of people that are like, for some reason or the other, they need to move or they want to upgrade, they basically bite the bullet. But now, because of the run-up, I mean, I think prices in states like Idaho, Arizona, Florida, and Texas, and so on, went up something like over 40% within like 18 months or so, 12 to 18 months. They have that is equity, right? That is equity. So prices have to go down below that for them to have to sell at a loss.
Right.
And so as a result, people starting to come to the realization that, do you see it? It sounds like you see it that way, that to the realization sometimes, well, I'll just sell for less. I'm still making money.
Yeah, still making money.
Instead of making 200 grand, I'm making 80 grand, but I'm still walking away with 80 grand, and I get to move where I need to move. I get to do what I need to do in life.
Yeah, because we do our quick looks. I'd be like, yeah, you're asking 5. The reality, though, is an 18. You bought it for 280. You haven't refied it. You'd like 5, maybe 450, but hey, I'm going to try at 320, and maybe we can find a low number that works for you, because I don't know your circumstances, but there's lots of people's like, yeah, I'd like to make, like you said, I'd like to make 200, but I need to move for X reason, and 70 or 80 grand is better than nothing, and I need, because there's always people who just need to move. So we're looking at that small number,
Yeah.
but those numbers work.
Say, why do you sell? Why do you not just rent it out? But not everyone wants to rent. There's people who have this thing in their mind that rental meanings that they have to wake up at midnight and clean toilets. And that's just obviously not true, but
right.
Go
It's
change their minds.
Yeah, it's really learning to put ourself in the other person's shoes. And for many of them, it's like in their mind, well, I can't get a new loan if I have this loan, and I can't afford 2 payments. And they're just, they haven't paid for the education. They've chosen not to learn. Not really aware that they've made this conscious choice, but they have. Yeah. And so because of that, they don't see the options are available. So then when an investor comes in and offers them a below market offer, which is what you need to do as an investor.
Right. Otherwise you can't make money.
Otherwise you can't make money. I mean, we just came out of an era where another generation had to learn that real estate doesn't always go up forever, and re-leveraging everything you own nonstop for eternity is not a good plan. Just take the cash out and put it in, take the cash out, put it in. That all works until it stops going up, and it stops going up on average every 10 to 14 years. So this is a normal downturn is normal. And, the veterans get it. Some of them forget it. But the new people is always like, oh, my God, it doesn't go up anymore. No, 40% in 18 months is not normal.